Investing money is essential for building wealth, but choosing the wrong investments can lead to significant losses, putting your finances at risk. In 2024, with the global economy facing uncertainties and volatile markets, it's more important than ever to know where not to put your money. In this video, I'm going to list 10 terrible investments that could cause you to go broke if you decide to invest in them this year. We'll explore each one and understand why they are so risky and what you should do to protect your wealth. Let's get started. 1. Speculative cryptocurrencies. In recent years, cryptocurrencies have attracted a lot of attention, and some investors have made fortunes by investing in them. However, in 2024, the cryptocurrency market is more volatile than ever, especially when it comes to speculative coins. Why is it a bad investment? Speculative cryptocurrencies, such as new altcoins or tokens launched without a clear purpose, are extremely risky. Many of these coins emerge through temporary hypes, without a solid foundation in terms of technology or utility. These assets can be highly manipulated, and prices can plummet as quickly as they rise. In 2024, with increasing regulation in the sector and the volatility of established cryptocurrencies like Bitcoin still high, investing in speculative coins can result in significant losses, if not a total loss of the invested capital. 2. Real estate in saturated markets. Investing in real estate is traditionally seen as a safe haven, but in 2024, some real estate markets are so saturated that the risks outweigh the benefits. Why is it a bad investment? Saturated markets, such as major urban centers, where property prices are already extremely high, offer little room for appreciation. Additionally, high interest rates make financing more expensive, reducing demand for new purchases. In areas where the supply of real estate exceeds demand, prices may start to fall, especially if the economy enters a recession. This can leave investors with properties they can't sell or rent, resulting in significant financial losses. 3. Overvalued tech companies. In recent years, many tech companies have seen their stock prices soar, but in 2024, the sector is showing signs of fatigue, especially for companies that are already highly valued. Why is it a bad investment? Tech companies that are highly valued may be on the verge of a correction. When a company's stock is traded at extremely high multiples relative to its earnings or revenue, the risk of a downturn is significant. Any disappointment in earnings or growth forecasts can trigger a massive sell-off, causing stock values to plummet. Additionally, with rising interest rates, the cost of capital for these companies is increasing, which could further pressure their results. 4. Sovereign debt from countries at risk of default. Investing in government-issued debt securities may seem safe, but in 2024, some countries are facing serious economic problems and may not be able to honor their debts. Why is it a bad investment? Countries with unstable or politically troubled economies face a high risk of default. Investing in these countries' debt securities can result in substantial losses if the government fails to pay interest or principal. Moreover, the depreciation of these countries' currencies can further erode the value of your investment. In 2024, some emerging markets are particularly vulnerable to these risks, making their debt securities an extremely risky bet. 5. Zombie companies' stocks. The term zombie company refers to companies that can survive only because they continue to have access to cheap credit, but do not generate enough profit to cover their operational costs. Why is it a bad investment? In 2024, with rising interest rates, many of these zombie companies will struggle to refinance their debts, which could lead to bankruptcy. Investing in stocks of companies that are just surviving may seem attractive if the stock prices are low, but the risk is enormous. If the company cannot restructure its finances or access to credit is cut off, investors could lose everything. Additionally, increasing competition and economic slowdown could worsen these companies' situations even further. But now, let me ask you this. Do you think it's hard to make a YouTube video like this one? And what if I told you that in 1 month, you could earn between $5,000 and $10,000 per month as extra income by creating simple videos for YouTube like this one? I have a complete and straightforward course that I developed for a single payment of $29.90. $29.90 won't make you richer or poorer. But what if this program works for you? Well, the link is in the first pinned comment of the video and in the About section of the channel, okay? If you're interested, just click the link to know more. But now, back to the content. 6. High-yield investment programs, HYIPs. HYIPs, high-yield investment programs, are schemes that promise extremely high returns in a short period, often through investments in cryptocurrencies or other high-risk assets. Why is it a bad investment? HIPs are often scams or Ponzi schemes, where early investors are paid with money from new investors rather than profits from real investments. These schemes rely on a constant influx of new participants to continue paying promised returns. Eventually, when the flow of new investors dries up, the scheme collapses, leaving most investors with heavy losses. In 2024, with the growing popularity of cryptocurrencies and other volatile assets, the number of HYIPs is increasing, making them even more dangerous. 7. Physical gold and silver investments. Without liquidity, gold and silver are often seen as safe haven assets in times of economic uncertainty. However, investing in physical gold and silver may not be as safe as it seems, especially if you don't consider liquidity. Why is it a bad investment? While gold and silver can be good for diversification, buying these precious metals in physical form, such as bars or coins, presents liquidity challenges. In times of financial need, selling physical gold or silver can be difficult and expensive, especially if you need to convert them quickly into cash. Additionally, storage and security costs can erode your returns over time. With rising inflation and increasing interest rates, the value of gold and silver may not appreciate as expected, making them less attractive than other, more liquid investments. 8. Franchises in saturated sectors. Investing in a franchise can be a good way to start a business, but in 2024, choosing the wrong sector can be disastrous, especially in saturated markets. Why is it a bad investment? Some sectors, such as fast food restaurants or fitness gyms, are highly saturated in many regions. This means that competition is fierce, and new businesses may struggle to attract customers and generate enough profit to cover operational costs and franchise fees. Moreover, with the economy in an uncertain situation, consumers' purchasing power may decline, leading to reduced demand for non-essential services. Investing in a franchise in a saturated sector can lead to bankruptcy if the business cannot differentiate itself or grow in a competitive market. 9. Corporate debt securities from struggling companies. Corporate debt securities can offer attractive yields, but investing in companies facing financial difficulties can be extremely risky in 2024. Why is it a bad investment? Struggling companies often issue debt securities with high yields to attract investors, but these bonds come with a high risk of default. If the company cannot restructure or improve its financial situation, it may end up going bankrupt, leaving investors without interest payments or principal recovery. With the global economy showing signs of slowing down and interest rates rising, many companies struggling to stay afloat may not be able to honor their debts, making these bonds a dangerous bet. 10. Timeshares and shared vacation properties. Timeshares or shared vacation properties are marketed as an affordable way to own a vacation property. However, in 2024, this type of investment could be a financial disaster. Why is it a bad investment? Timeshares are notoriously difficult to sell, and ongoing costs such as maintenance fees can be high and increase over time. Additionally, the economy of sharing a property is not as advantageous as it seems at first glance. In times of economic uncertainty, people tend to cut luxury expenses, such as vacations, making it even harder to find someone to take over or buy your share in a timeshare. Moreover, the value of a timeshare often does not appreciate like a traditional property, which means you may never recover the money invested. These are the 10 worst investments you can make in 2024. From speculative cryptocurrencies to timeshares and struggling companies' debt securities, each of these investments has the potential to lead your finances to collapse if you're not careful. Instead of betting on risky investments, it's essential to focus on safe, well-founded opportunities that can provide sustainable growth over time. If you enjoyed this video, leave your comment below, like the video, and subscribe to the channel for more tips on where to invest and how to protect your wealth. See you next time.